night about the credits, um, and the potential kind of huge boon that Tesla's on tap to receive. Maybe does it make sense for those who didn't see that thread last night to maybe give an overview of that and what the opportunity is, and then maybe I can jump in and say what I was started digging into and finding some potential cause for not concern, but maybe just pause when evaluating the opportunity.
Sure. So, like bare minimum, it looks like Tesla is going to get 1.5 billion in tax credits starting next year, starting January 1st. And it could be a little more depending on the output of Gigafactory Nevada. So Tesla has a claim on all the tax credits and some other accounting things from Gigafactory Nevada. This is in their agreement with Panasonic from summer of 2020. And Matt raised an important issue that's also in the legislation for the Inflation Reduction Act, that there's also a 15% minimum corporate tax, and wondering how much tax credits Tesla can actually use. Is that good, Matt?
Yeah, no, that's helpful overview. I mean, the first thing that kind of caught my eye was that Tesla already effectively doesn't pay any taxes in the United States because they have this massive deferred tax asset on their balance sheet. So if you look at the actual amount, they have over $11 billion of deferred tax assets, but they only believe that they're going to be able to monetize 2 billion of those because they expire at various times. So my first kind of question was, all right, well, if they have extra tax credits, but they already can't even come close to using the huge kind of pool of tax credits or of deferred tax assets, at least, that they're entitled to, which do carry forward year over year. And they've got this $9 billion write down on this asset because they don't think they'll be able to realize it. Then to what, how valuable is it actually to have another kind of set of tax credits? So that was my first point, and I do think that there's some validity in thinking through that. But as Bradford rightly pointed out, there is an option. I don't know if it's with all the credits, Bradford, but at least with some of them, to have them paid in cash. So that's one piece of it.
Yeah.
And is that for the full 1.5 billion?
Yeah, it's not capped by amount. The taxpayer can elect to do it for like 4 or 5 years, and this is an option that's in the legislation, where instead of receiving as a tax credit, they can receive as a direct payment, which I believe isn't as good, because then they would have income and then they would owe taxes on that income. So tax credits are like some of the best things you can have because they directly wipe out 100% of the taxes.
Yeah.
You know,
Yeah, so that potentially alleviates that concern. But then part of so these credits are all part of that Inflation Reduction Act, which was just signed into law. I think it was last month. But another provision of that, which I hadn't really seen much commentary on, so I started digging into it last night, was this alternative minimum corporate tax, essentially. And the way that this mechanism works, it's all the guidance on it is not out yet. But what does seem pretty clear is that for a C corporation, which Tesla is, and there's all sorts of other qualifiers in there, they have an alternative way of assessing the tax, and that is to take the GAAP financials of the company. So that would be Tesla's reported financials to investors, which is different than the way that the tax financials look. So they take that amount of pre-tax income, essentially. They make one adjustment, which seems relevant, and that is to eliminate the GAAP depreciation and replace it with the tax depreciation. And that's somewhat impactful because there is this concept called accelerated depreciation. So when Tesla is investing billions of dollars into gigafactories in Texas and expanding Fremont and putting all the equipment in and superchargers, all that PP&E, property, plant, and equipment that they're putting on their balance sheet, they can actually depreciate and get the benefit of that. The way that the tax
and Matt, that's a tax thing though, so they depreciate a lot faster for taxes, but as far as actual earnings, they're depreciating it slower, right?
Yeah, exactly. So GAAP depreciation is almost always lower or slower, I would say, than tax depreciation. So you might depreciate a gigafactory over 15 years, just kind of straight line depreciation for financial reporting purposes, but the tax laws will let you really accelerate that a lot of times within 7 years or so. It kind of depends on the asset, but there's this concept called modified accelerated cost recovery system makers. You may have heard of it that way. So it allows you to kind of front end a lot of the tax saving benefits of that. So you can make that one adjustment to your GAAP financials, and then they would assess a 15% tax on that amount. So my question as I was looking through this was, okay, maybe you do have $1.5 billion of these battery tax credits, and maybe you can even receive them as a cash payment to offset your taxes. But let's imagine a scenario where Tesla is incredibly profitable in 2024 or 2025, or choose your year. I think many of us believe that they're going to be kind of printing money and really drastically increasing their their earnings going forward. And so if that's the case, then this package as a whole, this Inflation Reduction Act as a whole, could be a net negative because their alternative minimum tax could be drastically higher, even with these new battery tax credits, than it otherwise would be if they were simply allowed to monetize their $11 billion of deferred tax assets. So that's kind of the crux of the question, I think, that we're trying to dig into right now.
And the negative, as you see it, is before this legislation happened, you felt like Tesla would not be paying taxes in the U.S. for a long time because they have these tax losses or these NOLs that they're accruing over time. So you felt like absent this legislation, their tax rate would have been very low for a long time in the U.S. Is that right?
Yeah. So specifically the cash that they pay for taxes. There are, I think, two questions. One is, what's the cash paid for taxes? And like, if you're doing a discounted cash flow analysis for valuation purposes, it's important to kind of get that reasonably close. So, they are paying taxes in other countries in which they operate. But, their total cash paid for taxes in 2021 was only 500, let's see, make sure I got the right one, $561 million. And I'm pretty sure that none of that actually went to the US federal government, because they have this $11 billion deferred tax asset that essentially allows them for the foreseeable future to offset any federal taxable income that they have with these kind of net operating loss carry forwards, and there's some other deductions that they qualify for as well. So my concern is, that you're bypassing that huge benefit, and you have this new alternative system of paying these taxes, and so they're probably the cash paid for taxes, I'm pretty sure will be increasing. And then the other piece of it is what is the GAAP effective tax rate. So even though they're not paying US federal tax, there is some amount that rolls through the financial statements, because they're essentially like using a little bit of that asset over time, and so it's got to make its way through the income statement. So the accounting on that and trying to sort through how it will impact cash paid for taxes, as well as the effective tax rate going forward, those are the questions. And the last one, I think, is particularly relevant because like, if you look at last quarter, I think they had an effective tax rate of around 9%. Now, part of that's like they got this Chinese income tax benefit that rolls through 2023. So they do have like a lower tax rate that will last, that long. And then they're roughly paying zero in the United States. Like I said earlier, there are some state income taxes, I think, here and there, but those are pretty small. So when we're thinking about earnings per share next year and using PE ratios and that sort of thing, if the tax rate jumps from 9% to 18 or something like that, it's not a huge impact necessarily, but it's somewhat material. So it's just the sort of thing that I want to try to maybe crowdsource some thinking on and see if we're missing anything.
So you're much closer to being like an international accountant man of mystery than I am. But you are not like, you don't, that's not something you specialize in. I want to make sure people know that. And I'm not an accountant, I'm not a lawyer. I happen to be a financial advisor. This is not financial advice. I do want to pull back for a second, and we did get some information last night where they might be able to offset 75% of the 15% minimum tax, and we'll share that in a second. But I want to pull back because I think some people will hear this and they might kind of phase out through some of the jargon and think like, why is Tesla not paying any tax? They're hugely profitable now. And maybe you could talk people through like some of the early days of the losses they accrued in the US while they were growing as a company. And you talked about the depreciation, so maybe we could talk about that for a second.
Yeah. So why does Tesla have this $11 billion deferred tax asset? That's probably a good place to start. So U.S. tax rules, at least up until this Inflation Reduction Act came along, essentially allowed you to what's called carry forward your net operating losses, which is like your tax reported net income. So imagine you started a company. Let's just use Tesla as an example. They started off with zero revenue for a number of years, right? And they were also investing in property, plant, and equipment, and they had staff that they were paying. So they had very large losses for the first 12 years of their existence, something like that. So just in 2019, I think it was like Q3 2019, they kind of flipped the switch to become profitable for the first time. And so the biggest piece of this bucket is that they have these carry forwards from all those years when they were unprofitable. They can offset their current year profitability to the extent that they had those losses before. So essentially it's a way to not punish companies for investing in that, like the startup phase. You get kind of a benefit for scrapping through those tough years. That's the way the U.S. tax system has worked for as long as I've been an observer of it. And yeah, maybe just a quick side note, like you said, Bradford, I'm not even a CPA. I'm a financial analyst by training, not a financial advisor, and much less a tax advisor. So this is really just for kind of educational and discussion purposes, not advice whatsoever. Really just we're trying to get close to the truth here. So that deferred tax, or that net operating loss carry forward, is a pretty big chunk of the benefit. But then there's other credits and things that go into that pile as well. So there's R&D credits, there's the deferred revenue, which doesn't get counted in. There are like warranty reserves, there's other things that kind of go into this bucket. And when you add all those together, as of end of 2021, it was that $11 billion figure. And I do think it's kind of interesting that like Tesla is so convinced essentially that they're not going to be able to monetize all of these credits, that they're writing it down from 11 billion to 2 billion. I mean, that's a pretty steep write down of an asset. One other item which came into effect last year in particular was the stock-based compensation plan from Elon. So that was essentially a $7 billion like tax write down that the company was able to, add to their deferred tax asset pile. So that was, I think, caused a huge jump in the deferred tax asset from, call it 2020 to 2021, and I'm sure that's actually grown somewhat through this year. But even still, with the pile growing so large, I do find it kind of interesting that they still haven't marked up the asset from that $2 billion mark. So and then with this change in the IRA, it's possible that they may even lower the deferred tax asset. There might be a one-time loss here as they mark this down, because tax benefits that they thought they might realize with this new minimum tax may not be realizable. So there's a lot of uncertainty right now, but that's hopefully some helpful kind of groundwork on the scope of the issue here.
So let me talk about stock-based compensation. So technically that is a loss for Tesla when they give Elon a bunch of shares for his awesome performance, and Elon certainly deserved it, but it is an accounting loss. I have a pushback at Tesla. I am not smarter than Zach Kirkhorn. I don't have that syndrome. So Tesla has some cash in various parts of the world. One place where they're earning profits and paying taxes is in China. Why couldn't Tesla repatriate some profits from China and or Europe and be able to put some use to that these NOL, the tax asset?
Yeah. So should we talk about the like the offsetting amount of was it the 75% of the credits?
Well, yeah, I'm just wondering if there's a way for them to repatriate. And I guess you don't know, but
yeah, this certainly gets to the kind of limits of my knowledge, but like thinking about the repatriation issue, like even then, I don't think it's necessarily that much of a benefit. So let's just say, for argument's sake, that they could repatriate, I don't know, $5 billion of income from their Chinese operations. And then all that income would in theory be taxed in the United States, but they've got this, 11 billion, or they've got this, what is it, $9 billion valuation allowance against their deferred tax asset. So technically they could actually avoid the tax on those foreign earnings. That makes sense, but is it material or impactful? Well, you're kind of moving your cash from your Chinese subsidiary to your US subsidiary, and you're not paying any taxes on it. And you wouldn't be paying any taxes anyways if you just left the cash over in this bucket in China. So to my mind, it's like it could be a lever to, like, if they feel they need more, cash for their operations in US rather than China, that might make sense. But I'm not convinced that it's not like if they avoided a $4 billion tax bill from repatriating earnings or something like that, it's not like that's actual savings relative to what they otherwise would have paid. So, and it could be like a one-time gain that would show up in their GAAP financials. I'm pretty sure it would be that, actually, but that again wouldn't be material. Analysts would completely ignore that. It's not actually a cash benefit, like we said. So to me, it doesn't seem like it'd be material either from a tax or from a GAAP or from a cash perspective. The only benefit would be maybe providing a little bit of flexibility if they do need more cash in kind of one pool or one subsidiary versus the other.
And Tesla's looking at a new gigafactory potentially in Canada. Would them repatriating to the US help them make the investment in Canada, or could they just go from China to Canada?
I don't know. So this certainly gets to the limits of my knowledge. Okay. So I don't think they could. Like, I think it has to be a US subsidiary. Like, so I'm pretty sure if they were they would have a Canadian subsidiary, and if they were trying to I don't even know if you'd call it repatriate. If you were trying to take, Chinese earnings and bring them into Canada, I'm pretty sure you'd be subject to whatever the, Canadian laws and regulations are around that, which I certainly know nothing about.
Okay. Well, if I'm Canada, I wouldn't mind a little cash and investment.
Yeah, but if you're
Well,
Tesla, like, what's the benefit of that?
yeah.
That's like the
Well,
only,
I think the main benefit is like China may become their most profitable region, and eventually they may have a hard time investing all that money back in their China operations, and but then eventually maybe the rules change, and then the tax is worse or whatever. Let's move on to the link that was shared to us by the accountant. I'm going to share my screen here on the little video we're making. And what we'll do is we'll share this link. Let's see, I think I can share this on the Twitter space, and maybe Matt, you could read what's on the screen.
yeah.
Oh,
So this is another component of the Inflation Reduction Act, and as the accountant who you guys should follow if you don't already, it's at CPA in NYC. He tweeted an excerpt from it that says the general business tax credits under Section 38 may offset up to 75% of a taxpayer's combined regular tax and CAMT, which is the corporate alternative minimum tax. These credits include many of the renewable energy tax credits that were introduced by or expanded in the IRA, the Inflation Reduction Act. So this is a really important piece of the pie, because as we laid out a couple of minutes ago, it does seem likely that the Tesla's alternative minimum tax would certainly be higher than the amount that they've been paying to the US so far. So I put together like a hypothetical example just to kind of walk through the math of what this would mean. So so let's say for a given year, Tesla has $10 billion of US pre-tax earnings, which would be certainly a step up from like where they are today. But in the next couple of years, they could certainly be having that level of earnings. The minimum tax on that would be $1.5 billion. But what this excerpt that the accountant pointed out is saying is that you could actually offset 75% of that $1.5 billion by these energy credits. So essentially, that would turn the $1.5 billion tax obligation, which would essentially be incremental to Tesla's otherwise what their tax obligation would have been otherwise because of the net operating losses. It would turn that $1.5 billion obligation into only $375 million. So still, more than they otherwise would be paying, because it's 375 million versus zero. But 375 million in the scheme of Tesla's kind of like overall operations is a pretty small amount. So certainly, I think it would be an increase in the effective tax rate. I think it would be an increase in the cash paid for taxes, but that's essentially a 3.75% tax rate, which is not a huge increase. So we're not certain that we've got this math and this understanding right, but I think that's a really important piece to kind of dampen the worst case scenario of how bad this Inflation Reduction Act alternative minimum tax situation could be.
yeah, and I just wanted to highlight Matt's thinking on this issue, what he's able to find. I know I've been really excited about this issue and pounding the table on it. Matt, let's use a slightly different hypothetical, because you're using a 1.5 billion as a minimum tax number, and that's like the same as the tax credit. So let's say the tax number from the 15% minimum tax was 2 billion or higher, then theoretically, if this 75% thing limit is correct, then if Tesla has 1.5 billion in tax credits, then they could use that against the 2 billion tax obligation. Is that right?
Yeah, because it's up to the way that the language is stated, that it's up to 75%. So if the 1.5 billion of credits that Tesla is allowed to recognize here are lower than 75% of their tax obligation, then they could recognize the full amount. That's my understanding. So yeah, that certainly would apply. But I think either way, it would result in an increase in taxes that Tesla's paying.
So could we take a question or comment from Mad Manx on the Twitter space? Is that cool? And we could repeat it on the video?
Yeah, definitely.
Let's see. Go ahead when you're ready.
Sorry, my phone dropped out. Were asking me to talk?
Yeah, go ahead. You can hear you fine.
Oh, okay. Is it okay if we step back, or what are you guys thinking?
I want to stay on this topic.
Specifically the 75%?
No, just the whole thing we've been talking about and not make it broader.
Start talking about FSD, I think is what Brad is saying.
Okay, yeah, no, I get that. So the repatriation issue, I do think there is a benefit to bringing that money back. Obviously, then you can use it for share buybacks. You know, that's been a topic we've talked about in the past. But there is going to be a massive amount of capital deployed in the United States. We just heard about the new lithium carbonate refinery factory. We're talking about possible mines. We're talking about a massive deployment of the supercharger network that is also going to be subsidized by the feds. Talking about another gigafactory potentially, expanding New York gigafactory to incorporate cell manufacturing again. So I just think there's going to be, in part because of this IRA, just massive amounts of capital spent in the United States, which repatriating the profits from China would allow you to use at least as seed capital for a lot of that. So I don't think it's wise to just dismiss that offhand, but I think there is a benefit there. The direct pay issue, I've read through the bill a couple times. I think it's only for the first 5 years that you can get direct pay on the advanced manufacturing tax credits.
Yep.
And then the other kind of elephant in the room is the enhanced.
Let's pause credit for a second. I want to go ahead and just repeat the question or the comments and have Matt react to it. So the main thrust of what he's saying is that there's other uses of cash. Tesla could use it possibly for a buyback of shares. They could also use it for capital expenditures for all the investment they're doing in the United States, whether it's charging infrastructure, refining, new gigafactory, more battery production in the US. Yeah, go ahead, Matt.
Yeah, so I don't disagree with any of that. Like I wasn't saying that repatriation is just a dumb idea and they shouldn't do it and there's no value. To me, like the points that Mad Manx brings up are certainly relevant, and it gives Tesla operational flexibility. And I would absolutely defer to management to make decisions that are in their best kind of interest to move that cash around in the way that's most beneficial to the company. I think where I was coming from, and maybe being a little bit more dismissive than others might think, is I look at a lot of things with my valuation hat on. And so if I'm a market participant looking at Tesla's plans and everything, it doesn't really change my calculus on Tesla's earnings potential or their effective tax rate or anything like that going forward. So I'm sure there's optimized ways that they can manage this with this change of rules. My point in saying it's probably not that material is just on like it won't be a big EPS impact, for example, and it won't really change their cash flow or their cash paid for taxes. That was really my point more than anything. So But yeah, Mad makes, I appreciate you bringing that up, and you can move on to the next point.
Well, I want to respond too. So
Oh, sure.
hang on one second, Matt. So if you look at stock-based compensation, I would guess that Tesla is strongly cash flow positive in the US. So I don't think they necessarily have a shortage of cash. I think it's more of a shortage of the right people and being able to move as quickly. Where I would push back a little bit on you, Matt, is you know, Tesla is investing really well. You know, I've done math on their gigafactories, and their return on invested capital approaches over 100% after they're fully scaled. So it may help the valuation eventually if Tesla was cash limited, which I'm not sure if they are in the US. So go ahead with the next part of your comments and questions.
There's always more you can do with cash flow, right? You could go out and buy out your service center leases and own your service centers. You could, you know, that's what kind of like Google has been doing, right? They've been buying all their corporate headquarter buildings because they have this extra cash. So I just think there's basically unlimited uses for US cash that you can, you know, maybe get, I don't know, 7-8% return on, I would think would be kind of an expectation for the person you're leasing a property from. So just I just think there's so many opportunities to spend the money. I guess my next point was, it's kind of along the same lines though. I mean, when we start talking about energy assets, like mega pack deployments, solar deployments, things like that, you're also talking about massive potential capital spend where Tesla can decide now, hey, you know, what percentage of this energy mega pack deployment in California we want to own and what part we want to sell. So you get into interesting questions there, especially with the new investment tax credit, which covers between 30 and 50% of the total cost you'll get a tax credit for. So that one's a little bit harder. That tax credit is going to be harder for Tesla to utilize. But there are